Hello, everyone. I think we can get started. I see there's a couple of latecomers, and we'll make sure they are able to join the webinar. Welcome, and I want to thank you for taking the time today to join us. We hope you will find this presentation meaningful and relevant, and that you will take away some knowledge that you can apply to your organization. This is the first in a 5-part webinar series and is hosted by Innovus. The series is scheduled to occur every Friday in May, with the final one scheduled for Friday, June 5th. We will be discussing topics that encompass the evolution of planning and budgeting. We will be focusing on pain points organizations and particularly planners face when managing their planning cycle. Today's presentation is going to be broken down into 4 parts. We'll provide you with a brief introduction of Innovus and our speakers, tell you a little bit about who we are and what we do. We're then going to transition over to what is strategic planning and how you can leverage strategic modeling in Oracle EPM Cloud to adopt a first-rate planning solution. There will be a live demonstration today that will be run by Gary Sorreo, and we will be answering questions throughout the webinar. You can type in your question in the chat window, and we'll do our best to answer all of those questions. Okay, so a little bit about who Innovus is and what we do. Innovus is a full service provider of consulting services, leveraging the Oracle EPM products. We've been an Oracle partner since 2012 and are recognized as a cloud excellence implementer using the Oracle EPM Cloud products. All of our resources, which are 100% onshore, closely work with both users and Oracle product development to ensure our clients leverage the full feature set of the Oracle EPM Cloud to get the highest return on their investment. Our approach to providing services to our clients is broken down into 4 areas. Configuration, where we work collaboratively with our clients and Oracle to implement and deploy the EPM solution. Adoption. This is where we assist our clients with championing the solution to make certain users embrace it throughout the organization. Support. We offer continuing support of that solution to ensure its ongoing success across the organization. And then finally, extension, where we provide guidance with extending the solution to further realize business benefits, increased ROI, and reduction in total cost of ownership throughout the organization. Ultimately, we are striving to be that trusted advisor to our clients to help realize their vision of performance management and business analytics. We not only implement the Oracle EPM Cloud, but we also use it internally to support our own planning and reporting processes at Innovus. Most recently, Innovus was recognized as a 2020 top 10 CPM solution provider by CFO Tech Outlook magazine. This is a testament to our success in the EPM space. Now a little bit about myself. I'm RJ Lenihan, Managing Partner at Innovus. I've been working in the EPM BI space going on 20 years now. I started in the late 90s on the customer side, working for an FP&A department at an insurance company in New York. And I used Hyperion Enterprise and Essbase in my day-to-day planning and reporting activities. In the 2000s, I moved on to consulting and expanded my experience with EPM. I started Innovus in 2012 and have worked to making it the premier Oracle EPM implementer. I specialize in requirements, design, and implementation of enterprise performance management and BI solutions. And then I have held the senior role in over 75 projects throughout that time. Now let me introduce you to Gary Sorreo. Gary.
Thanks, RJ. So yes, I'm Gary Sorreo. I oversee project delivery for Innovus Partners. My background, similar to RJ's, is on the finance side, and then grew up on-prem Essbase and planning. For the better part of the last decade, I've been on the consulting side working with Innovus, and then for the last 5 years or so, been very heavily dedicated to working within EPM Cloud. And I'm looking forward to helping educate everyone here on some of the functionality that you can get with EPM Cloud.
Thank you, Gary, for that. Now, finally, just a little bit about our complete schedule for the webinar series. Today's webinar is 60 minutes. The next 4 webinars will be 30 minutes. The recordings for each of these webinars will be posted on the Monday following the webinar on our Innovus website. And all registrants of the webinars will receive a link through email. Now that you know who we are, let's get to the good stuff and why you are here today. Strategic planning. For obvious reasons, this is a very relevant topic these days that many organizations are interested in better understanding and how it can benefit them. I'd like to share with you some key trends that we are seeing in strategic planning. The first being that organizations understand the need for proper alignment between management strategy and operational goals, and often the two are not aligned. Organizations are organic and comprise individuals and groups that often have competing priorities, and these two groups are often frequently at odds. There is a need to remove the common disconnect between strategy and tactics. The second trend is the realization that organizations need to engage in active planning activities. They realize that there needs to be a move towards a proactive approach to planning. How this is done is an understanding that often relevance of the plan is more important than precision. Having a plan that is reflective of the current state of affairs is much more important than a detailed plan that ties to the penny. And then finally, that leads to our third trend, which is adopting a rolling planning method. This allows for management to make better informed decisions that in many circumstances provide a competitive advantage. Traditional point-in-time planning can expose an organization to added risk, such as financial, operational, or competitive. As management recognizes that these trends become more relevant to their organization, there's an understanding that there needs to be a process in place that supports true and aligned planning, strategic, financial, and operational. With that, we have the strategic planning lifecycle that stresses planning as an actionable iterative process. This cycle is broken down into 3 parts. That starts with management communicating organizational strategy. This strategy is what should shape operational goals. The operational goals drive the financial plan, and as steps are executed to achieve those goals, they affect the financial results. These results are then used in turn to measure strategic success. Change in strategy are supported by financial results. This cycle ensures that the organization is executing strategy like a well-oiled machine. Strategy, operational goals, and financial planning and results are all aligned. They are harmonious. This becomes what is often called connected planning. What does this planning cycle look like in the Oracle EPM Cloud? Well, let's take a look at the architecture. Components of operational planning that roll up to the consolidated plan are supported in planning process-specific modules such as workforce, CapEx, and project financial planning. These parts roll up to the consolidated financial plan in the financial planning module. Plan data becomes available for reporting along with current and historical actual data in the financials reporting cube. Every one of these components is available through the ad hoc and production reporting tools available in the Oracle EPM Cloud. And then finally, the strategic modeling module sits on top of the financial and operational planning modules. It receives plan data from the financials planning module. Management leverages the module to develop and update its strategic plan. Once complete, that plan can then be pushed back to the financials planning module and used for further planning activities at both the financial and operational levels. This is the true connected, unified planning solution available in the Oracle EPM Cloud. So now that we've set the stage here for strategic planning, I'm going to now turn it over to Gary Sorreo, who will walk you through our demo.
Thank you, RJ. So yeah, we're going to go ahead and we're going to jump right into the application here, and I'm going to walk you through some of the core functionality and some of the features that are really helpful within strategic modeling. I do have a couple slides, functional slides, that if time allows, I will jump back to them and we can talk through them. But I want to make sure we're able to get through all of the live demo content. So I'm going to jump right in here, and we can, again, if we have questions as we're going through, please feel free to put them in the chat so that we can talk through them. Okay. Now, for the purposes of this demo, we're going to be dealing with the Vision Consolidated Business here. And as you can see, for what I have on the screen here, which is the model consolidation structure, we've modeled this business into various business segments. So you have computers, services, corporate center. We have a separate model within the strategic modeling module for an acquisition, which can be excluded from our baseline case. In the computer segment, we have separate models that have been created to evaluate a couple of capital projects for a plant expansion and a facility upgrade. Both are excluded from our baseline scenario. So you'll notice there next to acquisition target A, facility upgrade and plant expansion, because we're looking at our baseline business case here, we're excluding those when we're consolidating our model. Now, additionally, we're able to break out our services division by region to better analyze each section. So you'll see there within services, we have the different regions. And so this consolidation structure gives you an overall picture of how each piece consolidates to the total business and how we can easily include and exclude certain segments from our baseline case. Now, we're going to dive even deeper into this consolidation structure and how it can be used for other business cases a little bit later. Now, if we take a look at, right now, we're looking at our North America regional model. So right here in North America, you'll see on my side panel, I've opened up the model in SmartView. So you'll notice I'm going to be jumping back and forth between SmartView and the web. And you really have the ability to use both when you're in strategic modeling, very similar to any other EPM product that you're used to using. So if you take a look at this North American regional model I have on the screen, in this case, we're looking at North America. We're producing, and this is out of the box, we're producing an income statement, we're producing a balance sheet, and we're producing a cash flow statement for 5 years. So with strategic modeling's built-in accounting logic, these statements are always going to tie to one another, and the balance sheet will always balance. So these reports are fully interactive. You have the ability to update the columns and the rows on the fly, and we're going to see a lot of that functionality a little bit later in the demonstration, okay? In addition to financial logic, strategic modeling has a built-in calendar. That calendar can, and I just want to open it here so you can see it. So just give me 1 second. So see here, we have the built-in calendar, and that's able to meet the fiscal calendar of your organization. It automatically understands actual versus forecast time periods, how many days should be in each time period based on the calendar selected. So that allows you to create forecast methods for specific time periods, for example, dividends or tax payments, or you can add or change time detail on the fly, knowing that the forecast methods will automatically adjust to the correct number of days in the period. So that's in this time periods window is where you would manage that type of functionality. And you'll notice for specific years within our model, so 16, 17, 18, we're providing more detail. And then as we get to the later years in our model, so 19, 20, 21, we're only going to be performing the analysis or actually setting up our model to run on an annual basis. So we're not going to go down to that monthly detail. And you have the ability to change that, and everything will recalculate on the fly if you decide to change that down the line. Now, before we really dive into the core functionality of strategic modeling, I want to talk a little bit about how we get data into the model. So if you have an existing EPM Cloud environment with a built-out application for, as RJ mentioned before, with plan types for financials, workforce, CapEx, and so forth, we can leverage that application to not only build out the strategic model, but also to map the data from your annual plan or forecast directly to your strategic model to populate your baseline business case. So that alone is a huge value add, because we know that the starting point for the model is coming directly from your planning and budgeting application, as opposed to a disjointed process of manually entering data into, potentially an Excel spreadsheet, for example. So I just want to show you what that flow of data could look like. So what I have on the screen right now, and anybody on this call or on this webinar right now who is used to using any of the Oracle EPM products, this will look very familiar to you. This is a retrieve, and I'm connected to the financials cube right now, and I'm looking at consolidated workforce data. So this is data that was calculated within a workforce cube and then ultimately consolidated into my financials cube. Okay, so I've stripped out all the employee detail, and now I have a total compensation number for the total year, and I'm looking at $5.349 million. Okay, now if I jump over to strategic modeling and I just take a look at the entity that this data came from, I'll be able to see that the data values that I have in that retrieve are the same values that are being populated in my model here. So you'll notice here for 2018, which was the year on my retrieve, my salary expense that I've loaded into my strategic model matches that 5.349 million. Okay, now, what if you want to go back and change that data, and then you want that to flow into your strategic model so that it can flow through for the 5 years of your long range plan? What we do is we utilize data maps. Okay, so we have a data map that we've created, and this is part of the initial configuration of strategic modeling. We're in our data exchange, which again may look familiar to you if you've worked with data maps in the past. And within this specific data map where we're moving data from financials to strategic modeling, we go through a mapping exercise of saying this entity maps to this specific model. This is my plan scenario, is my base case. I have account mapping. So this is the important mapping where I'm telling it, I want my, and I'll jump back here for a second, I want my OFS underscore total compensation, which is going to be my total compensation dollar amount, to map to the salary expense account within my strategic model. So this data map is where you identify all of the mappings between the dimensionality within your underlying planning and budgeting application into your strategic model for purposes of seeding the data. Then from there, strategic model will take whatever your forecast methods are and forecast that data out for 5 years. So I just wanted to show this to you because this is very important to see how easy it is to say, I have data in my underlying cube, I want that to seed my strategic plan. So for example, if we were to go back to our model here, and we have information that leads us to believe that we're going to need to increase our budgeted salaries, we can go into, an underlying data form that's in our planning and budgeting application. We can update this information. We're going to submit that data. And now my total compensation dollar amount for FY18 has increased from 5.3 million to 5.949 million. So now all I would have to do is simply run this data map, and it's going to update that value for me in my strategic model, and it's going to forecast out the values for the out years. So if I jump back now to my strategic model, and I take a look one more time at my Finance US entity, I can see here now that the value populated for my 2018 salary expense is no longer 5.3 million, it's the 5.949 million. And what it's done is it's also used the growth percentages that I've used for the 3 out years, and it's updated those values as well. So again, data maps are a huge piece of strategic modeling because that is the key to moving data between your cubes, and it gives you that repeatable process of being able to bring in updated data into your strategic model and have that calculated out for you. Now, the one other thing I want to point out with data maps before we jump out of here is the fact that the data movement can be bidirectional. So not only do you have the ability to move the data from your underlying planning cubes into strategic modeling, but now that you have this 5-year long-range plan, you may want to take this data and move it from your strategic model into your planning and budgeting cube to seed a next year's plan or forecast or something along those lines. So you can use the same types of data maps, only the direction of the data is going to be reversed. So now you'll notice in my source here, I have my strategic model, whereas my target is one of my underlying planning cubes. And I'm going to follow the same mapping exercise to go from my model to my entity, my scenario to scenario, and then I can get detailed with my accounts to say, I want, the salary expense account to go to OFS underscore total compensation, or I want this travel expenses account to go specifically to account A underscore 62010. And this is where you would identify those mappings. And again, once that's done, it's just a matter of either manually running these data maps or scheduling the run of these data maps to move the data between your cubes. Okay?
Gary, we just got a quick question from the chat here. Are there any other data integration options with strategic modeling besides the data maps?
Yeah, so obviously data maps would be ideal, but not everybody will necessarily have all of the information in their underlying cubes that they may want to use for a long range plan. So you can follow similar methods of loading data like you would for other EPM applications. So whether it's a flat file load or some kind of other data integration, it could be a retrieve, or I'm sorry, an upload through SmartView. So you have multiple different options for loading data. We like to try and stick with the data maps because we know we're getting valid data with the ability to update it on the fly. But yeah, sure, there are other ad hoc methodologies of loading data if necessary.
Great, thanks.
All right, so if we jump back into our North America model in SmartView, and I'm going to take a look at the income statement tab for right now. So now that we have the data populated from our planning and budgeting cube, we can start to take a look at some of the core functionality we have in the strategic model. One of those pieces is called Audit Trail, and that capability enables you to view the calculation driving the value of any number on any report. So this audit trail that we're going to look at right now will lead us back to all the way back to the input where the data was input for a specific account. So if I want to look at, for example, here, I'm going to look at total cost of sales for December 18, let's say. So if I right click on this value, I go to SmartView, Audit Trail, it's going to pop up my Audit Trail window. And I can start to take a look at how this value is being derived. And again, this is being done right from the income statement report. So I'm looking at total cost of sales services. I then start to see that there's two values. There's the cost of sales services multiplied by the total operating revenue. If I drill deeper into cost of sales service, I get down to the actual input level. So what I'm doing here is I'm given the ability to actually modify the values that are input for a particular cell right here on the report. So if I wanted to change the value from 55 to 65, I could do that right here without having to jump back to the account view tab, which is normally where my data input would occur. And you'll notice here it has already updated the 65. And then if I save this value, it'll calculate through onto the income statement. So again, you have that ability to not only audit how the value is being calculated, but you have the ability to change input data right from the report, so you don't have to jump around to multiple different screens if you know that a particular value is changing. Now, if I start to drill into a particular account like total operating revenues, for example, and I go into services revenue and I go into my installation specifically, I can start to understand how what the forecast method that's being used to calculate the value. So for example, I want to understand how this services revenue installation value is being populated. So what I can do is I can click on this forecast method button, and it's going to pop up another window for me. And it's going to walk through what the forecast methodology and the logic that it's using to calculate this number. So it's forecasting it as a value for service revenues. It's using a standard forecast type. Here, installation service revenue for 2018 is calculated by taking the prior year value for the same account and increasing it by a percentage. So that's why we see here that the forecast method is a growth rate year over year. Okay, so we can see the forecast method that's assigned. And in essence, what we're doing here is we're mimicking, what's being done today in an Excel model, for example. You might have a value in 1 year and you're using some kind of percent growth driver to increase it year over year. So in this particular example, the driver is year over year growth, but you can select other methodologies. So if you desire to create, and if you so desire, you can create additional custom methods as well. So similarly, if you wanted to enter an expense as a percent of another account, you could do that, such as sales. So if you wanted something to be driven off as a percent of sales, you could do that as well. So you have all of these different forecast methodologies out of the box that can be utilized. Now, if I close out a forecast method, I'm going to take a look at total returns and allowances here. Now, strategic modeling's financial logic gives you the ability to add account detail on the fly. And you can do that safely knowing that any sub-accounts that you add on the fly will automatically flow through to the financial statement. So for example, if we wanted to add additional sub-accounts to total returns and allowances, we could do that on the fly right from the report. So you'll see here right now, I'm just clicking on any cell within total returns and allowances. I'm going to click on sub-accounts. It's going to pop up a window here. It's already highlighting the total returns and allowances because that was the value I had highlighted when I clicked on the sub-accounts button. And you'll see here that today there are 2 existing sub-accounts within total returns and allowances. So it has 2 children right now. It has sales returns and it has sales discounts. Now I want to add, I've decided I need a little bit more detail in my total returns and allowances, so I want to add another child there. So I can do that right here. I'm going to click add. I'm just going to go with the next sequential number. I have a 100 and a 200, so I'm going to call this one 300. And then I need to give it a name. And for this particular account, let's say this is sales allowances. And so I'm adding a sub account with the ID 300, and it's called sales allowances. And I'm going to choose additive because I want the pieces to add up to the total. So I want these 3 children to add up to the total returns and allowances. So I'm going to leave that as additive. I'm going to click OK. Now, if I click on the audit trail, which we were just looking at, as soon as this refreshes, I'll be able to see the sub-account detail that's already been added. So when I go to Audit Trail here, not only do I see the total sales returns and the total sales discounts, which already existed, I'm already seeing the sales allowances member, which I just added. And you'll notice there's no data there because that member didn't exist until I just added it. But if I wanted to, I could double click on it and I could get all the way down to the input value, and I could input a value for October 17 or whatever month and period it is. So that quickly, you're able to reflect a change in your account structure. And again, you can do that right on the fly from the report to enter data. Or if we were to jump back to the account view tab, which has our complete listing of accounts, and I were to refresh that, when I look at the total sales and allowances member, I should see the new sub accounts there as well. And if I wanted to input data on this tab instead, I could input data here as opposed to inputting it specifically on the report tab.
Gary, we got another question in the chat window around drilling when you're ready.
Sure.
Okay. So the question is, it's around Audit Trail, and I think what we're looking for here is what are the drilling capabilities within the Audit Trail? Like obviously you're drilling down to lower level of detail, I expect, within the strategic model, but what about drilling back or drilling through to maybe data outside the strategic model, and just what are the drilling capabilities when it comes to Audit Trail?
So when we're talking about drilling, in the Audit Trail within strategic modeling, we're talking about drilling into the hierarchy essentially. So we're not really talking about drill through to source. We're talking more about drilling into, so similar to the way you would drill through your outline or into your outline from the highest level to the lowest level, you're able to drill into the children and the pieces that make up a calculation. So if it's a value times another value, or if it's taking a value from a prior year and multiplying it by growth percentage, that's the type of drilling that we're referring to here. If you wanted to be able to drill through to source data, that would more likely be something that would live in your underlying detailed, planning and budgeting cubes, where you could then drill through to source data. I don't know if that answers the question.
And would that be handled through data maps?
So the data maps, so there isn't any drill through functionality with the data maps. The data maps would identify how to move the data from the underlying planning cubes into strategic modeling. But again, if you were then to flip over to looking at one of your planning and budgeting cubes and we had drill through enabled there, you would then be able to drill through to the source. So keep in mind, we're at a much higher level within the strategic model. So we don't necessarily have that link that we would have to the source data, say from a GL or something along those lines. So you would really have to go from strategic model to an underlying planning cube, but then from the planning cube, you could drill through to source data if you desired.
Got it. And we got another question around the sub-accounts that are being added in the strategic modeling, the strategic model. Do those sub-accounts get added back to the source system so that actuals could be posted against them, or are they purely for planning purposes?
No, so these accounts that are getting added are purely for planning purposes. Anything that you're doing within the strategic model is not getting pushed back, especially metadata-wise, is not getting pushed back to your planning and budgeting cube. So more than likely, you're never going to have more detail in your strategic model than you do in your underlying planning cube. So the functionality I'm showing you with the sub-accounts is you probably had those 3 sub-accounts in your underlying planning and budgeting cube, but when you first built out your strategic model, you didn't think you were going to need all of them. But then as you started to work through your model a few different times, you said, you know what, I want to see this additional sub-account detail, so I'm going to add it. And then I would be able to source that data from my underlying cube. But no, you will not see any metadata that you build in the strategic model is not going to get pushed back to your underlying cubes.
Great questions, everyone. Keep them coming. Gary, just doing a quick time check. We're at about the halfway point, so just want to give you that.
Okay, so perfect. Thanks. So we'll keep moving. So one additional item I wanted to show you with the sub-accounts before we move on from there is you have the ability also on the fly with the report to change how you're displaying the specific sub-accounts. So keep in mind on this report currently, we're only showing total returns and allowances. But if you decide that you want to see the detail on the report, I don't just want to see the total. I want to be able to see all of the pieces that make up the total. You can change that right here from the report. So we would go up to display options. I'm going to check the box that says expand sub-accounts. And you'll notice here now it has the 3 sub-accounts within total returns and allowances, including the one that I just created. And I want to show them, so I'm going to click OK. And if I refresh this report, once it comes back, it's going to increase the row set to now not only show me the total returns and allowances, but it's going to show me the pieces that make up total returns and allowances. So you see there, now I can see my sales returns, my sales discounts, my sales allowances, and now I have my total returns and allowances. So you have that flexibility, again, on the fly, not only to create that sub-account, but also to now throw it onto the report so I can see that detail when I'm reporting. All right, now another important function that exists within the model is the what-if analysis or the scenario comparison. So if I click on Scenario Manager at the top here, it's going to pop open a Scenario Manager window for me. Scenarios can be created where you can choose which account assumptions you'd like to change from the expected case. So I can create unlimited scenarios by simply clicking the New button up here and selecting the accounts for the new scenario. So if I know that in my expected scenario, I'm going to have assumptions for all these accounts. And in my upside scenario, I'm going to want to change assumptions for these specific accounts. I can call out which accounts I know I'm going to actually consider to have potential upside and what the new values would be. So I'm basically telling it when I go to my upside case, these are the assumptions I'm going to want to store different values for. Okay. And here we've already created scenarios for upside, recession, divestiture. So you have the ability to create many different scenarios and you can manage different sets of assumptions across the different scenarios for one specific model or for all of your models. Now, if we have multiple scenarios, one thing we might want to do is have the ability to view them on the report, right? So similar to the way that we just updated our report to show us the sub-accounts that we added on the fly. Now I have additional scenarios and I want to be able to report on those scenarios. So another thing I can do right from the report is if I go to the report formats button right here from the income statement, I'm going to change it so that I can have an alternate format type here. I'm going to do current and named scenario. And the scenario that I now want to compare to, because expected is already on there, I also want to be able to view my upside case, okay? My variances that I wanted to show, I'm going to say currency for now. I just want to see dollar value variances. In this particular case, I'm not going to look at percentage variance, okay? I'm going to click Apply to Current Report, and then I'm going to refresh this report. Now, as this report's refreshing, what's happening is it's actually on the fly updating the column set so that not only is it going to show me the expected scenario, but it's also going to show me the upside scenario, and it's also going to include a variance column. So again, you're able to not only create these additional scenarios and load separate sets of data to be able to do your what-if analysis, but on the fly, you can add those scenarios to your reports to say, okay, I now have an income statement that's showing me my expected scenario versus my upside scenario, and then what the variance is. And it's going to give that to me for every period that I'm displaying on the report. So if I'm displaying monthly data like I am here for some years, or I'm just displaying quarterly or annual data, it's going to give me the ability to see that comparison. So you'll notice here, I now have a column for October 16, and all the other periods I have an expected column, I have an upside column, and I have my variance column. So if I run a calculation on this, I would be able to see my calculated variances. But again, what I'm showing you here is not only do you have the ability to create those scenarios, but then again, on the fly, you can modify your report structure to be able to reflect what you're, the data that you're looking at. All right, now I'm going to jump over to one of our other models to start to take a look at some additional functionality. So this is the Insight entity, and this is one of our entities within our computers portion of the business here within our sample company. And we're going to start to take a look at our expected versus our expansion scenario in this case, okay? Oh, my Excel crashed. Bear with me one second. I always have too many things open in Excel, and that always happens to me. I have to learn to manage my Excel windows. So what we're going to look at here specifically, though, as I mentioned, is some scenario comparison. And we're going to start to see, how we can use different scenarios and run different functions on that data. RJ, I don't know if we had any questions that you wanted to address.
Yeah,
I'm just logging back in here real quick.
Yeah, another question came up through the chat window. Can scenarios be formatted to appear in colors and distinguish from regular data? So what are the formatting capabilities on the reports that you just displayed? Like, what are the formatting capabilities?
Yeah, so when it comes to formatting, it's more around what's being displayed on the reports. You don't have as much control over things like you would in Financial Reporting Studio, where you could kind of use conditional formatting and color code cells and use traffic lighting and things like that. But one of the options you have with strategic modeling, again, because it's something that lives within your EPM Cloud environment, one of the reporting options is to take the data that you're creating from your strategic plan and moving it into an ASO reporting cube. And then from there, you would have the full functionality of being able to build out your reports like you would when you're doing it for any of your other modules using Financial Reporting Studio, where you would have that full capability to use conditional formatting for color coding values and things of that nature. So that's definitely an option. And if you do want to get really detailed with the way you're formatting your reports, that's probably the route that we would recommend you take.
Great.
Okay. All right, so we're looking at our Insight entity within our computers segment of our business. And one thing I want to focus on here specifically is we're looking at the units sold in tablets, okay? So we're talking about tablet sales, and we see here that if we go out to January of 18, we're forecasting a number for our tablet sales. Oops, I'm gonna go to January 18. We're forecasting a number for our tablet sales, which is 33.954. Okay, which is in thousands, just so you're aware. So that's units that we're forecasting for January 18. Now, keep in mind, that's the expected scenario because that's the point of view I have up there right now. But as everyone here is aware, you have that scenario manager capability. So I want to keep a different value or a different assumption for units sold in tablets in my expansion scenario. So in my expansion scenario, that number is more like it's going to be in the 80s. I don't think we're going to be at 33,000. I think we're going to be more at like 85,000. Okay. So we have the ability to say, this is my expected scenario. This is my expansion. If we expand production, this is what I think we can get to. Now, what I want to use that information for is to attempt to get to a particular return on invested capital. Okay. So if I jump over to my return on invested capital report that I have built out here for scenario analysis purposes, currently in my expansion scenario, I see here that I have this cell highlighted. My total return on invested capital by the time I get to 2021, if I am able to meet those expansion goals for tablet production, is 23.48%. Okay. But I want to use the goal seek functionality to say, well, what if I want that value to be more like 23.65%? Okay. I want to increase that value but I don't want to have to go back through my model and change all of my different assumptions to be able to get to that increased percentage. I want the system to tell me, what do I need to change to get to that 23.65%? So in that case, we would use the goal seek functionality, okay? So what I'm going to do here is I'm going to highlight the 23.48. I'm going to go to the strategic modeling ribbon and click goal seek. It's going to pop open the goal seek window for me. And I'm going to fill in a set of assumptions to be able to get to my desired result. So I want the return on invested capital account. That's the account we want to work on here. So I'm going to choose return on invested capital. In period 2021, so remember our target period is 2021, and we want to get it to 23.65%, because right now, if you see, it is at 23.48%, okay? Now, the way I want to get there is I want to change my average price in dollars of the tablets that I'm selling. So I'm basically telling it, I want you to tell me, if I start from July 17 all the way out to 2021, how much do I have to change the average price in dollars of my tablets sold to be able to get to a return on invested capital of 23.65%? And then what I'm going to do is I'm going to click seek, and it's going to run through the goal seek function, and it's going to tell me what the percentage increase needs to be by period to be able to get to that particular goal. So you see here, it's run through the model, and it's telling me the input data for the average price in dollars for tablets in periods July 17 through 2021 would need to be adjusted by 0.703%. So I'm going to look at that and I'm going to say, okay, that's fine. I agree with that. I'll take that increase. And all I have to do is click OK. And it's actually going to run through, and it's going to apply that increase to the average price in dollars in tablets. And it's going to recalculate the model. So now when I refresh my report here, I'll see that my return on invested capital has increased now to the 23.65%. And I didn't have to go back and change anything manually. It, for me, did that by just updating the account that I told it to update. Sorry about that. So by updating that, the goal seek function for that particular target account, I was able to have the data flow through and get me to my targeted 23.65% using the goal seek functionality. Okay. So now I'm going to jump back to the consolidation view for a second, which is what we were looking at in the beginning. So, you know, we've now gone through all of the different business segments in our process here, and we've determined that we can now consolidate our different scenarios. So in our baseline scenario, which we're looking at right now, you'll notice here for business case, for vision consolidated, we're looking at baseline. We're going to consolidate the expected scenarios of all of the company's existing business segments. So you'll notice here, every scenario for each of the pieces of my model are set to expected, because when I'm looking at baseline, I only want to take the expected case. And we're still excluding, remember, in my baseline case, I'm excluding acquisition target A, and I'm excluding my CapEx expenditure for facility upgrade and plan expansion. Now, for the expansion scenario, we chose to include the capital project, and you'll notice that acquisition target A is still excluded, but I'm now including my facility upgrade and my plan expansion. And you can see that I'm telling it, okay, for this case, for the insight particularly, I want to use expansion, because remember, expansion was the case we were looking at for our tablets. Everything else I want to keep as expected. So it's that quickly, you know, you can change the way in which your model is consolidating. So think of all the manual cell linking that would had to have occurred in Excel to run these different consolidations that we're setting up in a matter of seconds in strategic modeling. Also, there's no need to get any other teams involved, IT teams, to reconfigure the architecture of the consolidation. You can do all of that right here from this consolidation screen, okay? And then lastly, you know, if I were to change this to the acquisition scenario, you can see here, I'm now including my acquisition target A, and I'm using the synergy scenario, and I'm now excluding my CapEx expenditure.
So Gary, this sounds like scenario planning to me, or what people talk about when they talk about scenario planning. Is that right?
Yeah, absolutely. So, I mean, this is, you know, this is scenario planning at its best, the ability to have different data values, different assumptions stored across different scenarios, and being able to quickly compare those scenarios or consolidate the data in different ways so that you can quickly compare what the outcome is or the output is of the different scenarios. All right, now, once we've determined which consolidation we want to go with and we've consolidated our data, we now have the ability to look at all of the model information that's been produced in a consolidated fashion. So when we were looking at when we were looking at North America in particular, I showed you that there was an income statement, a balance sheet, and a cash flow created. And those reports that we were looking at were very specific to North America, the North American entity. But now what I want to do, because I've completed my forecast for all of the different pieces of my consolidation, I've consolidated that data up. I now want to look at those financial statements from a consolidated point of view. So now I can open up my Vision consolidated entity, which is my total company, and I can go to my consolidating income statement, and now I'm able to see all of my different accounts or my metrics. In this case, I'm looking at a consolidated income statement. So my row set has all of the accounts I would expect to see in an income statement, and across the columns, I'm able to see all of the different pieces that are making up my consolidated company, and then I can see a total company. And I can also specify, as you'll see here, which scenario I'm looking at when I'm looking at this consolidated income statement. So for this case, I'm looking at expected. For the acquisition, I'm looking at synergies. And for my Vision total company, I'm looking at the acquisition because I want to include that acquisition target A. So at the end here, you finally get to a point where I've taken all of the different pieces, I've consolidated them up, and now I can report on this data in a consolidated fashion. And again, if you wanted to make changes, it's just a matter of jumping back into the underlying models, making a quick change, rerunning the consolidation, and I can report on the results. Okay. Now, the last piece of functionality I want to show you, and I think we should have time for it, is around running financial simulations within strategic modeling. So one of the very powerful capabilities of strategic modeling is the ability to run Monte Carlo style simulations on your models that you've built. So for purposes of this portion of the demo, we're going to work with the sales organization specifically. So I'm going to navigate to Sales US. And I'm going to display the base scenario here, because I want to be looking at base case. And for the accounts, I only want to look at the income statement accounts for the purposes of this example. So we're going to focus on the calculation of sales and sales-related expenses. So in the base scenario for this particular model, we're calculating revenue using a combination of direct input, formulas, and other accounts driven by forecasted growth percentages. So kind of all the different flavors of how you would arrive at a value within your model. So for example, product sales are calculated as a formula which takes unit volume and multiplies it by product price, while services revenue are calculated using a growth percentage applied to your prior year value. And something like maintenance revenue is a free-form direct input value, okay? So additionally, line items such as cost of goods sold, selling expense, salary expense, those are all calculated as a percent of another account, in this case, sales. So if you remember from earlier, we can see all of this by using the Audit Trail functionality. So if I were to click on a cost of goods sold cell here, and I went to my Audit Trail, you'll remember that it will tell me how that number is being arrived at. So it's going to pop open the Audit Trail pane within the model here, and it's going to show me you're getting to your cost of goods sold in 2018 for $397 million by taking the input value of cost of goods sold, which is 57, and multiplying it 57% and multiplying it by sales. And my sales are $698 million. So you see here my sales dollar amount, $698 million. And I was arriving at cost of goods by calculating a percentage. So again, remember, you have that Audit Trail capability to walk through how your accounts are being calculated, okay? So now that we have a better understanding of how this particular model is set up, we can talk about how we can use the simulation functionality within strategic modeling to either confirm or disprove the accuracy of our assumptions and the resulting forecasted amounts that we're seeing here. So the strategic modeling simulation function is used to automatically generate hundreds of what-if scenarios for your model. So each what-if scenario is considered one trial run of the simulation. Now, before you can run the simulation, you're required to identify the uncertain inputs in your model, or what we would refer to as your assumptions. So that would be a lot of the driver values that we just talked about that are used to calculate revenue and expenses. So in the simulation settings, so I'm going to go to the simulation window, and I'm going to go to the settings. I have the ability to select the number of trials that are going to be executed when I run a simulation. In addition to that, I have the ability to select the number sequence. Let me just pull it open so you guys can see it. So within the simulation, I can identify the number of trials to run. In this case, the default is set to 500 trials. I can choose my number sequence. So I'm going to say to vary my random number sequence each time. And then I can choose my methodology. So you have the option of Monte Carlo versus Latin hypercube. Now, if you're familiar with Monte Carlo, it gives you a completely random set of results each time you run your trial within the parameters that you identify, okay? With Latin hypercube, when it creates each time it creates your random number sequence in your trial, it's going to try to keep a more even distribution of your values across your min and your max, okay? So for the purposes of this demonstration, we're going to keep it at 500 trials, and we're going to keep it on Monte Carlo. Okay, so what we have to do next is we need to identify the assumptions that we're going to use, because we want to run our simulation for sales. So keep in mind our sales value is $698 million. We want to identify how accurate that forecasted sales value is in our expansion scenario. Okay, so we're going to change this to expansion. And so we haven't changed anything here yet. So our expansion scenario matches what's in our base scenario. And so again, we have our sales value of $698 million. So what we need to do is we need to identify the assumptions that we're going to use when running the simulation to tell us, are these assumptions accurate, and is the sales dollar amount that we're trying to get to an accurate forecast, okay? So unit volume is the first assumption that we're going to work with. And I want to identify that as an assumption because that's an important value that's going to impact my forecast sales, because keep in mind, product sales is based on volume times price, okay? So once I click set assumption here, it's going to ask me to choose a distribution type specific to that assumption. So you have the choice of 6 different distribution types. You have normal, triangular, uniform, log normal, beta pert, and yes or no. The more common types that are used are normal, which allows you to enter a mean and a standard deviation. You have triangular, where you can enter a minimum and a maximum value, where the probability of hitting your min or max are 0. And then you have uniform, where again, you can enter a min and a max, but all values will be equally likely to occur between your min and your max. So keep in mind, with triangular, your values are more likely to hit somewhere in between your min and your max. With uniform, equal probability that any of the values between your min and your max will get hit, okay? So for unit volume, we'll choose triangular, and we're gonna set a min and a max value. So in this case, my min here, I think is, if I look at historical data, is 14. So I'll enter 14 as my min. I have a max here at 2021 of 19.134. So I'll make my maximum 20. And then for likeliest, I'm just going to pick something in the, in the 16 range here. So you'll notice once I set my min, my max, and my likeliest, it then distributes my values based on the triangular distribution using the inputs that I've specified. So you'll notice it starts to skew where the majority of the values are going to occur for this particular assumption. Now for unit volume, for services revenue, sorry. So for services revenue, I'm going to click set assumption. And I'm going to set services revenue to normal. So in that case, I'm only going to have to choose a mean and a standard deviation. So I'm going to choose normal. I'm going to leave the mean at 15 because that's right around the center of where we're at. I'll leave the standard deviation at 1.5. And then for the one last assumption I'll use here is going to be maintenance revenue. So for maintenance revenue, I'm going to set it to uniform. And then it's just going to ask me to set a min and a max value. And for purposes of this, I'll make my min 20 because if I go back to 2016, I have a value of 20, and I'll set my max to 30 because that's the maximum value I'm forecasting out for the 5 years. Okay, so I've set all 3 of my assumptions. You'll notice now the cells are highlighted in green. The next thing I want to do is I want to go to my sales cell, and I'm actually going to run the simulation. So the first thing I need to do is click on the sales cell and click set forecast, and that's going to prepare me to run my simulation. So you'll notice here the only value that's showing in the graph currently is the current value that I have forecasted, or my base case value, which is 698 million. So I'm going to click run simulation, and as it's starting to run, it's running through the 500 trials. So you see here, it's running through all 500 trials, and it's now populating values based on the assumptions that I've identified. Now, keep in mind, the more trials you run, generally, the more accurate your simulation. But you can hit a point where if you run too many trials, you kind of get to that law of diminishing returns. So generally, we're probably somewhere within 500 and 1,000 trials. That's kind of the sweet spot for running your simulations. So we're seeing here that our simulation has completed. And now what it's providing me is a certainty of achieving my particular sales number, okay? So it's coming up with a worst case scenario, a best case scenario, a certainty of achieving based on the inputs that I've identified. So what we're seeing here is it's telling me that I have almost 100% certainty of achieving the $698 million sales number, which means that the inputs that I've identified, so for unit volume, for services revenue, and for maintenance revenue, these are based on this Monte Carlo simulation that I've just run. These are very accurate predictions, okay? So if I had changed this number to something like, if I had changed this growth percentage to something like 25% as opposed to 11%, and I were to calculate that or save it and calculate it, you know, my sales number is obviously going to increase significantly, but the probability of me achieving that number is going to be much less. So you'll notice here, I changed my unit volume to 25% increase as opposed to 11, which is what it was at. That has caused my sales dollar figure to increase to 777 million. And you'll notice if I go back to my simulation window, it's showing me that I have a 0% certainty of achieving that dollar amount. So basically, it's telling me that, you know, this unit volume forecasted number is just completely out of whack. I need to go back and reassess my inputs to get to that sales number. So the bottom line is this simulation capability really gives you a way to kind of check your numbers to say, okay, this is our forecast, but is our forecast worth anything? You know, how accurate are these numbers that we're forecasting? So that's where the power of the simulation comes in within strategic modeling, because it's actually telling you, okay, you've created this forecast and we've forecasted it out for you for 5 years, but now you need to take a look at these numbers and say, do they actually make sense? And running these simulations is what's going to give you that visibility into the probability of actually achieving your forecasted results. And that's a pretty powerful tool. And we're coming right up against time. And with that, that concludes my portion of the live demo. So I just want to make sure we have a couple minutes left to walk through any additional questions and just to close it out.
Gary, there's actually one quick question on the, by the way, great job to explain Monte Carlo and Latin hypercube and simulation. And like, I think you did that in under 10 minutes. That's pretty impressive. That's
yeah, I tried to get to that pretty quick.
So, but again, hopefully we didn't leave anyone's head swimming, but of course this is a recording and you'll be able to access this webinar in the future. But real quick, one quick question here. Can you drill down on scenario comparisons to reveal more details that stand out? That was the last question that came across. So just going back to your scenario comparisons, are there any drilling capabilities in that report that you showed us where you're comparing the scenarios? Is it the same as what we've seen before?
Yes, so I mean, as much detail as you have within, so the account structure that you build out in your strategic model, as much detail as you have there is the detail in which you can see the scenario comparison. So if you have a very detailed set of accounts that you're building in your model and you have additional sub-account detail, you can, all of the scenario comparison you're doing can occur at that level of detail.
Great, great. Oh, and one last question. Just want to make sure we get everyone in here. Last one that came across, can you migrate from on-prem HSF to EPM Cloud, strategic modeling EPM Cloud? Yes,
so you absolutely can. It can be done manually through SmartView. You can migrate both the model and the reports. One caveat to that, you know, the success of the migration definitely depends on your existing model and the reports that you have. So we would want to go through an exercise of reviewing that model just to confirm that we would be able to migrate it without modification. But yes, there absolutely is a path to migrating on-prem to the cloud strategic modeling for sure.
Great, great answer. Well, again, thanks everyone. This concludes our first part in the 5-part webinar series. We hope to see you next Friday when we'll be talking about managing planning hierarchies within Oracle EPM Cloud. Have a great day.
Thank you, everyone.